All right, we'll now talk about Pillar 2. So Pillar 2 applies to the big end of town. So even a subset of significant global entities. The government, the Treasury recently released the exposure draft legislation last Friday. So here we'll give you an update of the exposure draft legislation. So firstly, it is an OECD initiative. And the purpose is to stop countries racing to the bottom in terms of their corporate tax rate. So what Pillar 2 seeks to do is to ensure that in each and every jurisdiction in which you operate, you pay an effective tax rate of at least 50%. This is not a global average, it is at each jurisdictional level. So Australia, being part of the OECD, will adopt Pillar 2, similar to about 135 countries, OECD and inclusive framework countries, who will also implement Pillar 2. So as I said, the exposure draft legislation, the EM and the consultation paper was released last Friday. And for those who missed it, the rules, which I'm going to talk about, was released a day before on Thursday. Now, we did hold a Pillar 2 webinar recently. It is still relevant because the law is meant to be the same as the OECD rules. So I recommend that you view the video to get a high-level view of the Pillar 2 rules. So when does the Pillar 2 start and who does it apply to? So it applies from financial years beginning 1 January 2024, which is just passed. So for December balances, it's already applying to you now. There is an untaxed payment rule, which is deferred to 1 January 2025. So in the webinar, I spoke about these two things. The top-up tax will only apply after the legislation received royal assent. So who does the rules apply to? It applies to multinational groups, so you need to be doing business in at least 2 countries with an accounting consolidated turnover of at least euro 750 million or more. And this is the currency and threshold that is contained in the exposure draft legislation, the assessment bill. So you look at 2 out of the 4 years before the start year. So for December balance at 1 January 2024, you should already know whether or not Pillar 2 applies to you. In performing this turnover, you must include the turnover of excluded entities. Now, I understand that the universities in attendance as well, so I'll say this. Excluded entities are basically outside the Pillar 2 rules. So they do not need to do the calculation. They do not need to lodge form. So universities should satisfy the definition of a non-profit association, organization, which is an excluded entity. But be careful not to assume that because you're an excluded entity, your subsidiaries are excluded entities as well. They themselves need to satisfy certain conditions. So it's worth looking at that. So they might have Pillar 2 obligations. In performing the test, you need to take into account mergers and acquisition transactions as well. So be aware, you might need to combine the turnover of multiple groups, even if the merger happens on the last day before the start year. So this is a proposed legislation. So Australia is, instead of referring to the OECD rules as being part of our legislation, including Pillar 2 by reference, which I understand is the New Zealand approach, we are replicating, copying or rewriting the Pillar 2 into our tax laws. Now, I'll leave it to the lawmakers and policymakers to explain why this is necessary. But it was explained that the purpose of this is to bring Pillar 2 taxes within the definition of the taxation law. So practically, that means that the existing provisions, the tax administration provisions, will apply to the Pillar 2 taxes. So that includes the ATO information gathering powers, applying SGE penalties, GIC's penalties, requiring you to lodge forms, even the amendment period, for example. The underlying premise is that despite we're going to have globe rules and guidance, and then we're going to have our legislation and EM and rulings and guidance, the underlying premise is that they will be consistent with the globe rules and guidance. So how is the law brought into our legislation? There is an imposition bills which impose the Pillar 2 taxes in accordance with our constitution. And then there is an assessment bill that will assess the Pillar 2 tax. Sitting outside of it is what is called the rules or the subordinated legislation, which will be determined under the minister's rulemaking power. And the purpose of this is that to provide flexibility for whatever OECD make changes to the rules or provide certain further guidance. Importantly, the subordinated legislation includes the Transitional Cbc safe harbor provisions. I'll talk more about this shortly. Australia will also implement the domestic minimum tax. So in the, I would say, unlikely event that there is top-up tax payable with respect to Australian taxpayers, Australia will collect the top-up tax. So that is to protect the Australian revenue. There's also a standard 4-year amendment period, but I note that the Pillar 2 rules, for example, requires the effective tax rate or top-up tax to be recalculated if there is, for example, a DTL recapture, a DTL which does not reverse within 5 years. So I assume that there'll be adjustment for this. So what are the forms you need to lodge with the ATO? So there are 3 returns. One is the Global Information Return. So this is really informational. It will not raise assessments. It is consistent with the OECD standardized form, which was published on 17 July 2023. So you can actually download that form to have a look at it. It may also contain Australian-specific amendments as well. It captures general information, including your corporate structure, and can be lodged by the parent, and then the ATO is notified of that lodgement. There's a Globe Tax Return, which collects any top-up tax payable, and you need to lodge it even if your top-up tax is nil. And the Domestic Minimum Tax Return collects the domestic minimum tax. You must lodge those forms electronically, so you need software to convert the data. And you must lodge this within 15 months after the end of the fiscal year. There are conditions where it increased to 18 months. It is noted that the commissioner cannot extend the due date for the Global Information Return. So be aware of that in terms of SGE penalties. So in terms of what we would recommend is that you should assess whether or not the transitional safe harbor provisions apply. And why would you do that? If the transitional safe harbor rules apply to a particular jurisdiction, let's say Australia, the top-up tax is deemed to be nil, and we believe that you do not need to then perform the complex Globe Pillar 2 calculations, the calculation of globe income, adjusted covered taxes, which are complex calculations. You still need to lodge those 3 forms. You still need to provide general information, including your corporate group structure, but at least the complex calculations are deferred for potentially 3 fiscal years, which gives you additional time to consider the sources of data, automation, and software consideration. But nevertheless, I would recommend that you do not delay implementation any longer. For Australian headquartered groups, definitely perform those calculations now. That will inform you as to the level of compliance requirements at jurisdictional level. For foreign subs of HQ groups, you should initiate discussions with your group tax as to what information will they require from you and when. So would they do the calculation, or would they give you a template for you to do the calculation, or do you need to do the calculation using your own software and provide the information to them? So it's best to understand that, be clear, get clarity in relation to that. But definitely, I would say proactive safe harbor calculations may inform that discussion, or may make it quicker. So as to what Xiaoming is looking at, we are looking at extracting inputs from our CTS full compliance software. So for those here who are using the software, and linking that into our CTS Pillar 2 software. Our initial case studies indicates that there are data inputs that can be automated to streamline the calculations, and GL changes could enhance that automation. There are sources of information that might be outside your GL systems. But also, on the other hand, there are inputs that cannot be automated. You cannot automate everything. For example, the reversal of deferred tax liability that's not reversed in 5 years, that will require manual tracking and manual intervention in the calculation if it applies. We will be holding an updated Pillar 2 webinar and workshops, so keep an eye out for that.